Ever found yourself staring at your Venmo transactions, a tiny bead of sweat forming on your brow, and wondering, how on earth am I supposed to sort all this out for tax season? If so, you're definitely not alone. Venmo, with its seamless peer-to-peer payments and often playful emojis, has become an indispensable part of our financial lives. Whether you're splitting dinner with friends, paying your share of rent, or even running a small side hustle, those notifications pile up fast. But when April 15th rolls around, that convenience can morph into a headache if you haven't been keeping tabs. The truth is, while Venmo makes paying incredibly easy, it doesn't automatically organize your financial life for Uncle Sam. And that's where many people get tripped up. The casual nature of Venmo transactions can lull you into a false sense of security, making it easy to forget that not all money moving through the platform is created equal in the eyes of the IRS. Some payments are purely personal, a reimbursement from a friend for concert tickets, for example. Others, however, might be considered taxable income. Think payments for your freelance graphic design work, selling crafts online, or even that occasional dog walking gig. Distinguishing between the two, and keeping a clear record, is absolutely crucial to avoiding an unexpected tax bill or, even worse, an audit. The landscape of online payment platforms and tax regulations is constantly evolving. In recent years, there's been a significant shift, with the IRS paying closer attention to transactions made through apps like Venmo, PayPal, and Cash App. This heightened scrutiny means that understanding your obligations is more important than ever. Gone are the days when you could just hope for the best and assume small transactions would fly under the radar. The IRS is actively working to close the tax gap, and payment apps are a key part of that effort. So, how do you navigate this increasingly complex world? How do you ensure that your casual Venmo usage doesn't turn into a tax nightmare? The good news is, it's not as daunting as it might seem. With a little bit of foresight and some simple organizational strategies, you can transform your Venmo chaos into a clear, concise record that will make tax season a breeze. This isn't about becoming an accountant overnight, but rather adopting a few smart habits that will save you time, stress, and potentially money in the long run. The first and arguably most critical step in tracking your Venmo payments for tax purposes is understanding the distinction between personal payments and business payments. This might sound obvious, but in practice, the lines can often blur. A personal payment is typically a gift, a reimbursement, or a payment for shared personal expenses. For example, if you pay back a friend for a movie ticket, that's personal. If your roommate sends you their share of the rent, that's also personal. These types of transactions are generally not considered taxable income. On the other hand, business payments are those received for goods or services you provide, even if it's just a small side gig. If someone pays you through Venmo for a freelance writing assignment, that's business income. If you sell a handmade necklace and receive payment via Venmo, that's also business income. This distinction is vital because only business income is subject to income tax. Misclassifying business income as personal can lead to underreporting and potential penalties. Venmo itself tries to help with this by allowing users to tag payments as goods and services or personal. However, users don't always use this feature correctly, or they might simply forget. Therefore, relying solely on Venmo's tagging system isn't enough. You need your own robust tracking method. One of the simplest and most effective ways to track your Venmo payments is to download your transaction history regularly. Venmo allows you to export your statements, usually in a CSV format, which can then be opened in a spreadsheet program like Microsoft Excel or Google Sheets. This is your raw data, the foundation of your tax tracking system. Make it a habit to do this monthly, or at the very least, quarterly. Waiting until the end of the year to download thousands of transactions can be overwhelming and increase the likelihood of errors. Once you have your transaction history in a spreadsheet, the real work and the real organization begins. The first thing you'll want to do is add a new column for category or purpose. This is where you'll manually classify each transaction as either personal or business income. For business income, you might even want to get more granular, adding subcategories like freelance work, sales, consulting, etc., especially if you have multiple income streams. Another crucial column to add is notes or description. While Venmo transactions often have a short description, it might not be detailed enough for tax purposes. For example, if a payment is for lunch, you might want to clarify reimbursement for client lunch meeting if it's a business expense, or split lunch with Sarah if it's personal. The more detail you can provide, the easier it will be to justify your classifications if the IRS ever comes knocking. Let's talk about the dreaded 1099K form. For a while, there was a lot of confusion and even panic surrounding the $600 threshold for 1099K forms. Originally, the American Rescue Plan Act of 2021 lowered the reporting threshold for third-party payment networks like Venmo to $600 for goods and services transactions, regardless of the number of transactions. This meant that if you received more than $600 in business-related payments through Venmo in a calendar year, Venmo would issue you a 1099K form and report that income to the IRS. However, this implementation was delayed, and for the 2023 tax year, the threshold remained much higher, at over $20,000 in gross payments and more than 200 transactions. It's important to stay updated on these thresholds as they can change. Regardless of the threshold, any business income you receive, even if it's below the 1099K reporting limit, is taxable and must be reported on your tax return. The 1099K simply acts as an information return, notifying both you and the IRS of certain payments. It's not a bill, but it does mean the IRS knows about that income. So, even if you don't receive a 1099K from Venmo, you are still responsible for reporting all taxable income. This is why meticulous record keeping is so essential. Don't rely on the 1099K as your sole source of income information. It's a supplementary document, not a replacement for your own tracking. What about business expenses paid through Venmo? Just as you track income, you should also track expenses. If you use Venmo to pay for business-related items, say, office supplies, software subscriptions, or even a meal with a client, these can often be deductible expenses. Your spreadsheet should also include columns for expense category and business purpose for these outbound payments. Keeping receipts or digital records for these expenses is also crucial. A Venmo transaction alone might not be enough proof for the IRS. With that said, thanks for watching and until next time.